This is the Legacy Radio Network. You're listening to the Everything Financial Radio Show. Glad you're with me today. I'm your host, Dennis Tubbergen. We have a terrific show lined up for you this week. Joining me momentarily will be Mr. Karl Denninger. Karl, you have probably heard as a past guest on the Everything Financial Radio Show. Karl is a prolific economic commentator. His blog, I think there's probably 4 to 6 entries every day. So look forward to him joining us. Also on today's show, the International Monetary Fund said the United States economy is not going to grow as fast as we thought it would. And bad news from the manufacturing sector in June. Manufacturing in the United States is contracting. And just in case you wondered if we still make anything here, there are 9 companies that I'm going to profile today that are doing a terrific job. They're profitable. They're manufacturing here. And a bit of good news, there was a study done in April by the Boston Consulting Group, and the study found that a third of manufacturers with revenue over $1 billion a year were considering moving jobs back to the United States. That's good news. At 58 cents an hour, bringing manufacturing back to the United States was impossible. But now wages in coastal China are $3 to $6 an hour. And now all of a sudden it's starting to make some more sense. So a bit of good news that we will talk about as well. We'll also ask, has democracy reached its limit? I've often pointed out that I'm a libertarian capitalist, and as such I may be an endangered species. However, there's an article that I read this past week that talks about the distinct differences between democracy and capitalism, and sometimes we just lump these together. We'll talk about that on today's show as well. Also, I will remind you that we do have a few seats left for our discovery groups this week. We'll be over at Sunnybrook Country Club in Granville on Tuesday, July the 10th. We will be at Boulder Creek Golf Club this Thursday on July the 12th. We'll be over at the Highlands next week. That's on the Tuesday the 17th. You can go to personallegacyseminars.com. That's personallegacyseminars.com to get more information or to register. Please, if you have attended a discovery group in the last 3 months, don't register. Give someone else a chance. We have just a few seats left. Again, that is personallegacyseminars.com. Also, brand new offer. We've got a free book and CD titled A Little Book on Investing in Today's Economy. Talks about the economic cycles. It talks about also how to potentially survive a stock market crash. So if you've not yet requested your free copy of this book and CD while the offer's out there, you should do so by going to investingapproach.com. You know, the International Monetary Fund I mentioned forecasts that the United States economy will grow at just 2% this year. I don't happen to think that will be the case. I think that number will be revised downward, and I think the evidence suggests that we are already in a recession. The International Monetary Fund doesn't suggest that unemployment will change much this year. However, the way we calculate unemployment in this country is really not a very accurate number. We're going to chat with Mr. Karl Denninger about both of these things on today's show, and we will go to that interview now. I am pleased to have back on the Everything Financial Radio Show with me today good friend, Mr. Karl Denninger. Karl is a prolific commentator on all things financial and economic. And, Karl, always a pleasure to have you on the show. Thanks for being with us again today.
Oh, thank you very much.
Karl, on a recent blog posting, and I have been talking about this for a while, that I believe that a recession is imminent. In fact, we may already be in a recession. Give us your take.
Well, it's pretty simple. The indicators that I watch in terms of recession in the sense that our government likes to use it, which is a little different than the way that I tend to use it, are the regional Fed indices and, of course, the employment report. And the reason for that is fairly simple. The regional Fed indices gives you a very good indication of manufacturing activity around the country, even though manufacturing is only about 30% of the economy now. And the employment report, of course, tells us what's going on with regards to the balance between labor and government. And people always talk about labor and management, but in fact it is the balance between labor and government that makes government programs possible. And so what we see over the last couple of months is radical deterioration in both the Richmond and Philly Fed indices. And those are the two best predictors of broad economic activity. When you look at things like Dallas, for example, you see a rather skewed picture because of the energy situation down in in the Texas area. They have a economy that is much more resilient and tends to resist the kind of macroeconomic moves in both directions. The Philly Fed index is usually the best indicator, and Richmond is right behind that. Some people also like to look at Empire State. I'm not a big fan of the Empire Index. The employment indicator, on the other hand, is extremely important, and the one that the only number in there that matters in the employment report every month is the labor participation rate. That is the percentage of working-age people that actually have jobs. And the reason for this is that only working people pay taxes. So if you're trying to figure out what kind of sustainability situation you have and whether or not the economy is capable of expanding at a rate that will both fund government and make private payroll growth possible, you have to look at that number. And that has just been flat on its back for the last 2.5 years. A pronounced slowdown now showing up in the regional Fed indices. The durable goods numbers have not been particularly good. And what I've said recently is that it'll be another month of bad numbers. You know, one number is an interesting anecdote, 2 is a warning sign, and 3 is a trend. We've now got 2 in the can, and if we get another set of bad numbers, everybody and their brother is going to call a new recession. With the expected start from the NBER's perspective, somewhere around the fourth quarter, November, December timeframe. I think we're already in one. I think we never really got out of one in an honest fashion because we've just been borrowing money to make up what the private economy was not able to do. But in terms of the so-called official recession callers, I think you're going to hear them pipe up and say, all right, we're in one in November or December.
Carl, I want to go back and explore with you the difference between the reported or headline unemployment rate and the labor participation rate, because a lot of consumers and investors with 401ks, IRAs listening to this program are certainly confused. And do you want to comment and maybe just explain how misleading the headline unemployment number really is?
Well, yeah. The headline unemployment number is essentially worthless because the government does a couple of things, which are, you could call this book cooking, but it's been going on forever. And so if it surprises anybody at this point, you're not paying attention. The government only counts you as unemployed if you're actually out looking for work and can't find a job. So if you're not seeking employment for whatever reason, then the government doesn't consider you to be unemployed. Well, at some point, if you're sending out, 20 resumes a week and you're getting no phone calls, you stop because you're just wasting postage or fax time or, whatever means you're using. At this point, you drop off the so-called unemployed roll. There are a couple of other numbers embedded in the employment report, one of them being what's called U6, which supposedly includes disgruntled workers. It also includes people that have taken part-time jobs that would prefer to have full-time employment. But what I look at is the employment population ratio, which is what the Department of Labor calls it. I call the participation rate, or the employment as a percent of the population, or employment rate of the population. And that number dove dramatically. And in fact, if you look at where it stands today, we never recovered from the 2000 fall-off. Going into 2000, when the tech wreck happened, we were right around 64%. That is, 64% of the working-age people had jobs. That fell into the 62% area, never regained 64 throughout the 2000s. And then in 2008, when the Lehman collapse happened and all of the bad economic things that came from that, it fell down to 58 at the start of 2010, where it has remained since. And so we've never seen a number over 59 since that point in time. It just was essentially a flat line down the 58, 59% area. The importance of this change is that if you look at a historical chart of this, you'll find that this is a labor participation rate that approximately estimates back where we were in the 1950s, 1960s, and 1970s, before women entered the workforce en masse. And so, in general, this is a employment rate that mirrors the time when only men, for the most part, went and actually were out in the workforce. Most women, of course, stayed at home and tended the house. However, we have a government that is spending money and a social system that is spending money that is geared to the kind of labor participation rate we had in the 1990s and early 2000s, and there's just no support for it there.
Karl, we have in this segment about a minute left. Why don't you let everybody know where they can read your blog?
That is market-ticker.org, and that is the front page and always comes up with the most recent material.
And I will also, in the little bit of time that remains, get in a plug for our free book. It's titled The Little Book on Investing in Today's Economy. Someone interested can get it free of charge by going to investingapproach.com. That is investingapproach.com. Let us know where to mail the book, and we'll be glad to get it out to you. Could be one of the most important things that you read this year. We will continue our conversation with Mr. Karl Denninger when Everything Financial Radio returns after these words. Stay with us.